Now coming to the next adjustment, depreciation. If information related to depreciation is given in the adjustment after the trial balance or outside the trial balance, then it's an adjustment. So information related to depreciation on fixed assets or amortization of intangible assets is given, then what we'll do, we write the depreciation. Depreciation, we know that it's a non-cash expenses. Depreciation is what? It's a non-cash expenses. So depreciation will be reflected in the debit side of profit and loss account. It's an indirect expenses, and on the same time the depreciation will be deducted from the assets in the balance sheet. From that particular assets, this will be deducted in the balance sheet asset side. For example, so our topic of adjustment is depreciation. This is what I'm going to discuss about the adjustment depreciation. So suppose in the trial balance, machinery is 40,000, land and building is 1 lakh. Okay, this is given in the trial balance. And in adjustment it has given that the depreciate machinery at the rate of 10% and land and building at the rate of 5%. Okay, land and building at the rate of 5% and machinery at the rate of 10%. Then what we'll do in profit and loss account, in the debit side we will write to depreciation. Depreciation is an indirect expenses. Depreciation, okay, depreciation, machinery at the rate of 10%. So machinery rate is 10%. So machinery is how much? 40,000. 40,000. So 10% of 40,000 is how much? 4,000. 10% of 40,000 is 4,000. And land and building is how much? It is given in the trial balance 1 lakh. So, and depreciation on land and building is 5%. So 5% will calculate on 1 lakh. Okay, 1 lakh into 5 upon 100. So this will be land and building, depreciation on land and building will be 5,000. 5% of 1 lakh. 5% of 1 lakh. 1 lakh into 5 upon 100. So this is 5,000. Is it clear? 5,000. So depreciation on land and building is 5,000. Similarly, depreciation on machinery is 40,000 and the rate of depreciation on machinery is 10%. So 10% of 40,000 is 4,000. So write it in the debit side, to depreciation, machinery 4,000, land and building this, total depreciation is 9,000. Total depreciation on machine is 4, land and building is 5, total depreciation is 9,000. Where we will write profit and loss account, debit side. It's a indirect expenses. It's a non-cash expenses and indirect expenses. This will be shown over here. In balance sheet, this will be reflected in the asset side. So in asset side, when we write the machinery, you have to write the machinery which is given in the trial balance in the inner column. Machinery given in the trial balance is how much? It is 40,000. So write the amount 40,000 in the inner column, and then what we do, you deduct the depreciation which is charged on this machinery. Depreciation charged on machine is 4,000. So you deduct the 4,000 from it, 4,000 you deduct it from it and write the net value 36,000. This is called book value. After deducting depreciation, it is called written down value. So written down value of this machine after deduction of depreciation is 36. Same thing you do with the land and building. Land and building in the asset side, land and building, you write the land and building in the asset side land and building is how much? In the trial balance it is 1 lakh. So write the value 1 lakh in the inner column and then you deduct depreciation on land and building. Land and building depreciation is how much? 5,000 is the depreciation on land and building. So you deduct 5,000 depreciation from land and building. So this will be 95,000. 95,000 is the depreciation on land and building. Okay, is it clear? So depreciation, if it is given in the adjustment information regarding depreciation, then what we'll do, we will write the depreciation in the profit and loss account debit side, and in balance sheet from that particular assets we will deduct the depreciation and write the net figure after charging depreciation in the outer column to reflect the true financial position. The true financial position of machinery is how much? 36,000 after depreciation. Similarly, land and building, true financial position of land and building is 95,000. So purpose of balance sheet is to reflect the true financial positions, and the purpose of income statement is to reflect the true profit. Okay, true income, true profit or loss. So is it clear? Now coming to the next adjustment, interest on capital. If in the partnership deed or in the agreement it has mentioned that the firm or partnership will allow the interest on capital, then at the time of preparing profit and loss account, we'll do the provision for interest on capital if it is mentioned. So interest on capital is expense. Okay, interest on capital is the expense, it's an indirect expenses, okay, which is given to the proprietor of the business who has invested the money into business as capital to earn profit. So suppose capital of the proprietor is 2 lakhs, which is given in the trial balance. Suppose in trial balance capital is 2 lakhs, and in adjustment related to this capital and adjustment it has mentioned that provide interest on capital at the rate of 8% per annum. You have to do the provision for interest on capital at the rate of 8% per annum. So interest on capital which will be given by the business to the proprietor. So this is an expense. So what we'll do, we'll write the interest on capital in the debit side of profit and loss account to interest on capital. We'll write where? We'll write in the debit side of profit and loss account. So capital is how much? Capital is 2 lakhs is the capital amount is 2 lakhs, rate of interest on capital is 8%, so it is how much? It is 16,000 is the interest on capital. Okay, interest on capital is how much? It is 16,000. In balance sheet what we will do, capital we write in the liability side. Capital is the internal liability of the business, so write the capital over here 2 lakhs, and what you do, you add interest on capital to the capital. So interest on capital is how much? It is 16,000. So add 16,000 interest on capital. Okay, and write the amount in the outer column. If there is a profit, then you add the net profit. If there is a drawing, then you deduct the drawings, and then you write the figure in the outer column. This is for interest on capital. You know the entry for adjustment entry for interest on capital will be interest on capital account debit, interest on capital account debit to capital account. This is the adjustment entry for interest on capital. Interest on capital account debit to capital account, that is 16,000. This is the adjustment entry. related to interest on capital. So interest on capital will be reflected, we will shown in the debit side of profit and loss account, because interest will be paid by the business to the proprietor. So from business point of view, it's an expense. So they write in the debit side interest on capital, and in balance sheet it is not yet given, it is a provision, it's a provide, it is not yet given, it's a provision. So if it is not yet given, then the capital of the proprietor will be increased by 16,000, and now the capital is 2,16,000 after addition of interest on capital. If interest on capital is paid, then we are not going to add interest on capital. Then what we'll do, we'll deduct the amount from cash balance, because interest on capital is paid. So your cash balance will be reduced by that amount. In the asset side, what we'll do, we'll deduct from the cash balance, or if it is paid by check, then we'll deduct from the bank balance. Okay, here it's a provision. Provide means it's a provision. So provision, it means it is not paid. You have to do the provision for interest on capital. So interest on capital is not yet paid, that's why we have added to capital, and if it is paid, then we are not going to add to capital. Then what we'll do, we will deduct from the bank balance or cash balance. If it is paid by cash, then from the cash balance, and if it is paid by check, then from the bank balance we will deduct the interest on capital amount. But here the treatment will be same in the profit and loss account debit side, to interest on capital. Okay, and this is the adjusting entry. And if the interest on capital is paid, then entry will be what? If interest on capital is paid, then interest on capital account debit to cash account or bank account if it is paid, and if it is not paid, then transfer to capital account, Okay. Now coming to the next adjustment, interest on drawings. If it is given in the partnership deed or in the agreement that the interest will be given or interest will be charged on the amount of drawings, the firm or business will charge the interest on the amount of drawings. If the proprietor has withdrawn the amount for the personal use, then the firm or the business will charge the interest on that amount, if it is given in that partnership deed or in the business agreement. Then interest on drawing will be charged. Okay, interest on drawing is an income for the business, because whatever the amount the proprietor has withdrawn, either in cash or in kind, or availed any personal services of the business, is availed for their personal purpose, business services is availed by the proprietor for their personal use, then that is drawings. So if the amount is withdrawn or the goods is withdrawn or any services of the business is availed for the personal use, then that is drawing. So on that drawing, if the business charges the interest, then from business point of view, it's an income. So interest on drawing will be credited to PL account. Okay, and in balance sheet, this will be deducted from the capital. If it is not paid by the proprietor, then this will be deducted from their capital. For example, our interest on drawing is the adjustment what I am going to discuss. Interest on drawing, suppose in the trial balance drawing is 20,000. Drawings is how much? 20,000. Drawings have a debit balance, it's an assets. Drawing is what? It's an assets for the business, because business has given the money to the proprietor for personal use. It means business has given a short term loan to the proprietor, so it's an assets, debit balance. In adjustment, if it is mentioned in the adjustment or it is given in the adjustment that charge interest on drawing, suppose the rate of interest is 6% per annum, charge interest on drawing at the rate of 6% per annum, then what we'll do, in the profit and loss account we'll write credit side, this side income side, it's an indirect income by interest on drawing, interest on drawings. Is it clear? Interest on drawings. So interest on drawing, we will calculate it. Drawing amount is 20,000. Rate of interest is 6% per annum, and as the date of drawing is not mentioned over here, then we'll calculate the interest for 6 months only. If the date of drawing is not mentioned, then the interest will be calculated on average basis, means for 6 months. So 6 by 12. So interest on drawing will be 600. So write the 600 over here. 600 interest on drawing. It's an indirect income. And in balance sheet, in liability side, you write the capital first, which is given in the trial balance. You write the capital, add net profit if any. You add the net profit if any. You add the interest on capital if any. Okay, and from this total, what we do, we deduct the drawings, which one? 20,000, we deduct the drawings, as well as we will deduct the interest on drawings. Interest on drawings will also be deducted. Interest on drawings, how much it is? 600, we will deduct it. So from that amount, from this amount, we will deduct it and reflect the amount in the outer column. So capital, add net profit, and if there is a net loss, then net loss will be deducted. Add interest on capital, less drawings, which is given in the trial balance, less interest on drawing, which is given in the adjustment. So this will be deducted from this amount, and we will write the amount in the outer column. This amount will indicate the closing capital. So entry for interest on drawing is what? Interest on drawing entry is drawing account debit, drawings account debit to interest on drawing, to interest on drawings, drawing account debit to interest on drawings. Business has charged the interest on the amount of drawings. It is a charge. Business has charged. It means the proprietor has not paid the amount, not given the amount. Then drawing account debit to interest on drawing. If the proprietor has given the amount, then cash account debit, if it is given in cash, or if it is given by check, then bank account debit to interest on drawing. So if it is not given, then what we will do, we will deduct from the capital, because capital will reduce. If the business has charged the interest on drawing and the drawing interest amount is not given by the proprietor, then what the business will do at the end of the financial year, his capital will be reduced by that amount. As the capital drawing is reduced by that amount, in the same way interest on drawing will be reduced from their capital. And if it is given, then cash account debit or bank account debit to drawings account, then on that case, we are not going to do the treatment over here. We will, in the asset side, we will add to cash account or we will add to bank account. If it is given, if the proprietor has given the interest in cash or by check, then cash account debit or bank account debit to interest on drawing, then cash and bank balance will increase in the asset side. Okay, so this is the adjusting entry for interest on drawing. Drawing account debit to interest on drawing, if it is not paid. If it is given by the proprietor, then cash account debit or bank account debit to interest on drawing. So interest on drawing will be reflected in the credit side, because it's an indirect income for the business point of view, and this interest on drawing will be deducted from capital if it is not given. Interest on drawing is not given by the proprietor till at the end of the financial year, then that amount will be deducted from the capital to know the closing capital, actual closing capital. Okay. The next adjustment is interest on loan. Interest, if the partnership firm or the sole proprietor has taken any loan from the outside, maybe loan from friends, loan from relative, loan from financial institution, loan from bank, Okay, so on that loan the business has to pay the interest. So interest on loan is the financial charges. It's a financial charges. So interest on loan will reflect in the profit and loss account debit side because it's a financial charges. So and this will be reflected in the debit side, and if the interest on loan is not yet paid, then that amount will be included in the amount of loan in the liability side. When we are reflecting the loan amount in the liability side, then we will add the outstanding interest on loan if it is not paid. Now take one example related to interest on loan. Suppose in trial balance as at 31st March 2020, this is the trial balance on this date 31st March 2020. 10% loan from SBI is 30,000. 10% loan from SBI is 30,000. This is reflecting in the credit side of the trial balance. Interest on loan is reflecting in the trial balance is 1,000. Interest on loan SBI above loan is 1,000 in the debit side. It's an expense. In adjustment, it has mentioned that loan is taken on 1st October 2019. If the loan is taken on 1st October 2019, this 30,000 loan is taken on 1st October 2019 and the rate of interest on loan is 10%, then we will calculate the interest from October 1st October 2019 to 31st March 2020, means October, November, December, January, February and March. For 6 months we will calculate the interest, 6 upon 12. So we will calculate the interest for 6 months. So interest is 1,500 is the interest on loan. Interest on loan is how much? Interest on loan, what we have calculated in the working note is 1,500. However, in the trial balance it is reflecting 1,000 only. It means 500 interest on loan is not yet paid. So we'll write in the debit side in the PL account, profit and loss account, interest on loan which is given in the trial balance, it is 1,000. Okay. Add outstanding interest on loan, add outstanding interest on loan. How much it is? Outstanding interest is 1,500 as per our calculation and here it is 1,000. It means 500 is outstanding, not yet paid. So total interest on loan is 1,500. So we'll write this way, 1,500. Total interest on loan given in the trial balance is 1,000 and 500 is outstanding. How this outstanding we have calculated? Interest on loan we have calculated in the working note. The loan amount is 30,000 and rate of interest is 10% and loan is taken on 1st October 2019. Accounts closed on 31st March 2020. So 6 months interest will be calculated by us. So 6 months interest is 1,500 is the interest for 6 months. So 1,000 is recorded, it means 500 interest is outstanding, not yet paid. So you add the outstanding interest. In balance sheet, what you will do, you write the loan from 10% loan from SBI. In the inner column, you write 30,000. This is the loan amount. Add outstanding interest. You may add it or you write it separately even, outstanding interest on loan from SBI. How much it is? 500. So loan amount you may write it directly in the outer column, 30,000 this way. 30,000 is the 10% loan from SBI and write the outstanding interest on loan from SBI is 500, this outstanding amount. Or another way is what you will do, you write the loan from SBI 30,000 and add outstanding 500, and in outer column you may write 30,500. This is the another way of presentations. Okay, so the entry of this entry will be, what will be the entry of this adjustment? Interest on loan account debit, interest on loan from SBI account debit, from SBI account debit to outstanding interest, to outstanding interest on loan, to outstanding interest on loan 500. Interest on loan from SBI account debit to outstanding interest on loan 500. This is the adjusting entries. And balance sheet, this will be reflected in the liability side, and in profit and loss account, this outstanding part will be added to this amount to know the total interest on loan. Then we will get the true net profit and we will understand the true financial positions. Okay. Now coming to the next adjustment related to provision for bad and doubtful debts and further bad debts. Next adjustment is for additional bad debts, which is also known as further bad debts. If the information about the additional bad debts or further bad debts is given outside the trial balance, and another is what? Another adjustment, provision for bad and doubtful debts. If you do the provision for bad and doubtful debts, maybe in future there is a possibility of loss in terms of bad debts and we have a doubt on the collection, then we may do the provision for bad and doubtful debts. So how will do the adjustment if it is given? So come to the problem. Suppose in the trial balance which is going to prepare as at 31st March 2020, this is debit and credit side. Trial balance debtor is 40,000. Debtors is how much? 40,000 in the trial balance. Bad debts is in the trial balance is 50,000. Okay. Provision for bad and doubtful debts which is given in the trial balance, it's a old provision. It's a provision of the last year which is brought down this year. Okay. So if I'm going to show it in the ledger, then in the bad debts ledger, this bad debts will be in the debit side. March 31st, we'll add in the debit side to balance brought down. This is brought down from the previous year 500. Okay, bad debts have a debit balance, and this provision for bad and doubtful debts have a credit balance in the ledger of provision for bad and doubtful debts on March 31st by balance brought down, okay, you write the by balance brought down, okay, by balance brought down in the credit side. How much it is? 1500. This is the opening balance of bad and doubtful debts. I have posted in the concerned ledger. Bad debts ledger debit side to balance brought down on March 31st 2020, and provision for bad and doubtful debts credit balance. So I have reflected in the credit side by balance brought down. Okay. Now see, in adjustment, the two adjustment is given, number 1 and number 2. For number 1 is further bad debts, means additional bad debts. In addition to this, further bad debts given in the adjustment outside the trial balance. And second adjustment is new provision for bad and doubtful debt. This is the old provision. This is the provision of the last year, and this is the new provision. New provision for bad and doubtful debts is at the rate of 5%. 5% on what? 5% on debtors. So there are two adjustments related to this. So when I do this entry, journal entry, bad debts account debit, to sundry debtors, debtors. Bad debts account debit to sundry debtors. Further bad debts is how much? It is 1000. This is the journal entry for this further bad debts. In adjustment, we will do the entry like this. Bad debts account debit to sundry debtors, we will do the adjustment entry like this. Bad debts to sundry debtors. So in the ledger of bad debts, this will be reflected which side? In the ledger of bad debt, this will be reflected this side to sundry debtors. To sundry debtors. It is how much? 1000. Okay. And the total will be, the total of the bad debts will be transferred to on March 31st. This will be transferred to provision for bad and doubtful debts. Provision for bad and doubtful debts. And doubtful debts. This total will be transferred. Doubtful debts. So total is how much? Total is 1500 is the total. Debit side total is how much? 1500. So balancing is 1500. This 1500 will be transferred to by provision for bad and doubtful debts. So journal entry is what? Provision for bad and doubtful debts account debit. Provision for bad and doubtful debts. Bad and doubtful debts. Doubtful debts account debit to provision for bad and doubtful debts account debit to bad debts account. This will be the adjusting entry. Provision for bad and doubtful debts account debit to bad debts account 1500. This will be the adjusting entry. These are the two adjusting entry. I have passed it for this. Okay. Now this will be posted as well in the debit side of the provision for doubtful debts 31st March to bad debts. The posting of second one, provision for bad and doubtful debts to bad debts. It is how much? It is 1500. It is 1500. Okay. It is 1500. Now new provision is how much? New provision for bad and doubtful debts is 5%. You know how to calculate the new provision for bad and doubtful debts? Debtors is how much? Debtors is 40,000. Sundry debtors is 40,000. Sundry debtors is how much? 40,000. You first deduct the further bad debts from it. Further bad debts. You deduct the further bad debts. Further bad debts is how much? Further bad debts is 1000 is the further bad debts. So rest amount is 39,000. You calculate the 5% new provision on 39,000. Okay. 1950 rupees. 1950 rupees. This is the new provision for bad and doubtful debts. So write it on March 31st this side. To balance carried down. To balance carried down is 1950 rupees. Okay. 1950. And the difference amount will be transferred to profit and loss account, to PL account, to PL account, the difference amount. So this side total is how much? This side total is 0543, 3450 rupees. So total is 1950. This is the balancing figure will transfer to which account? Profit and loss account. So how we have calculated the new provision? New provision for bad and doubtful debts is 5% on which amount? Debtors is 40. From this debtors you deduct the further bad debts first and you calculate the new provision on the rest amount. It means 5% on 39,000. So it is 1950. This is the new provision for bad and doubtful debts. So in provision for bad and doubtful debt, this will be the balancing figure, new provision. Okay. So the next entry for this will be, if you see this entry, profit and loss account debit to provision for bad and doubtful debts. You write it over here, to provision for bad and doubtful debts. You can directly write it over here, to provision for bad and doubtful debts. Bad and doubtful debts. How much? 1950. This one, PL account debit to provision for bad and doubtful debts. Directly you can write it. Or another way of writing is what? In the books it has written like this. It is the way of writing. In the books it may be like this. To bad debts. To bad debts. This is 500. Add further bad debts. Further bad debts. How much it is? Further bad debts is 1000. Add new provision. New provision for bad and doubtful debts. Bad and doubtful debts. How much it is? 1950 is the new provision. You add this amount, okay, and you deduct old provision for bad and doubtful debts. Old provision is 1500, you deduct it, and after deduction you write the amount 1950. This is the another way of writing the amount. Or you may write the amount directly in the debit side, PL account debit to provision for doubtful debts. You directly write the to provision for doubtful debts 1950. In balance sheet, asset side, come to the asset side, sundry debtors is how much? Sundry debtors is 40,000, which is given in the balance sheet, 40,000. Less further bad debts, less further bad debts. Further bad debts is how much? Additional bad debts is 1000. You deduct it. Less new provision for bad and doubtful debts. New provision is 1950 is the new provision. So deduct it and then you write the amount in the outer column. Means how much amount we are going to write it? 40,000 minus 2950. So this will be 37,050 rupees. 37,050 rupees you write in the credit side. Sorry, asset side. You write in the asset side. This is the real debtors from whom we realize the amount. This much amount will be realized by us from the debtors after adjustment of the further bad debts and after the adjustment of the doubtful debts. New provision for doubtful debts. Is it clear? New provision for doubtful debts. So the entry for this will be what? If you are going to write the journal entry related to that, then the journal entry will be profit and loss account debit, to provision for bad and doubtful debts, provision for bad and doubtful debts, provision for bad and doubtful debts. How much it is? 1950. This is the journal entry of adjustment, profit and loss account debit to provision for bad and doubtful debts. This one directly. So the adjustment entry is bad debts to sundry debtors, provision for bad and doubtful debts to bad debts account, and this one is profit and loss account debit to provision for bad and doubtful debts. Okay, provision for bad and doubtful debts. Is it clear? If this side total is more, then we will write to profit and loss this side, and in that case the profit and loss we will write this side by provision for bad and doubtful debts. We will write this side instead of this side. Then this will be the credit side of profit and loss account. If the credit side total is more and debit is less, then the to PL account will be at this side. Okay, PL account will be at this side. Is it clear? Okay, and for this the entry will be provision for bad and doubtful debts account debit to sundry debtors accounts. Okay, provision for sundry debtors account debit to provision for bad and doubtful debts. The entry for this will be, if you prepare the debtors account, you may prepare the debtors account as well. Okay, debtors account can also be prepared. Opening balance debit side, to balance brought down. This will be posted in the credit side by bad debts, and credit side by provision for bad and doubtful debts, and thereafter by balance CD if you are going to prepare the sundry debtors account. So is it clear? In the debit side, bad debts, further bad debts, less new provision. Okay, add new provision and less old provision for bad and doubtful debts, and write the amount in the outer column, or you may write directly to provision for bad debts 1950 in the outer column. In case this side total is more and this side total is less, then the 2 PL account will come this side, then the posting will be this side. We will start with the old provision, then we will deduct the bad debts, further bad debts, and new provision will be deducted, and we will write the amount. So is it clear? And in balance sheet, debtors, less further bad debts, less new provision for bad and doubtful debts. If you want to prepare the sundry debtors ledger of sundry debtors account, then this will be prepared sundry debtors account. Okay, then this will be prepared like this. To balance brought down, that is 40,000 on March 31st. This will be to sundry by bad debts. This one is 1,000. Okay, by provision for bad and doubtful debts 1950 rupees. Okay, then you do the total, this side 40, and then you write the amount by balance carried down. This will be 37,050 rupees. These all entries done on 31st March 2020, March 31st. Okay, closing date.